Money matters can be complicated, especially in manufactured housing. Today, I'm going to demystify the financial side of manufactured home transactions, from taxes to financing options. Trust me, once you understand these concepts, you'll be able to guide your clients with confidence. Let's start with something that often confuses both agents and clients: the two different tax systems for manufactured homes. I remember when I first learned about this, it seemed so complicated, but really, it's pretty straightforward once you break it down. First, we have local property tax, or LPT. Think of this as the traditional way most homes are taxed. If your client buys a new manufactured home today, this is the system they'll be under. They'll pay their property taxes just like any other homeowner, usually in 2 installments each year. One of the nice perks: these taxes are typically tax deductible, just like with a traditional home. Now, here's where it gets interesting. Some older homes, specifically those sold before July 1st, 1980, fall under what we call the in lieu tax system, or ILT. It's more like how you register your car each year. Instead of property taxes, these homeowners pay an annual registration fee to the Department of Housing. I always make sure my clients understand which system their home falls under because it affects their monthly budgeting and tax planning. Let's talk about financing. And this is where things get really exciting because there are more options than most people realize. You know how many clients come to me thinking they can't get a loan for a manufactured home? I love seeing their faces when I explain all the possibilities. Let's start with chattel loans. These are specifically designed for manufactured homes that are considered personal property, typically homes in land lease communities. Yes, the interest rates are usually a bit higher than traditional mortgages, and the terms are shorter, but they often have lower closing costs and can close more quickly. For some clients, especially those looking to keep their overall loan amount lower, this can be the perfect solution. Now, when a manufactured home is classified as real property, meaning it's permanently affixed to owned land, that's when conventional mortgage financing comes into play. This is where we can often get those longer 30-year terms and lower interest rates that clients love. Plus, they can finance both the home and land together, which can be a huge advantage. Here's something that surprises many clients. FHA and VA loans are absolutely available for manufactured homes. The FHA actually has 2 different programs. Title Y is for personal property, while Title II is for real property. And for our veterans, VA loans can be an amazing option. No down payment required, and often with really competitive rates. Let me share a quick success story. I had clients who thought they'd never qualify for a manufactured home loan. They didn't know about all the special programs available: state housing authority programs, rural development loans, even some local assistance options. We found a program that fit their situation perfectly, and now they're happy homeowners. When it comes to qualifying for financing, each loan type has its own requirements. I always tell my clients it's like putting together a puzzle. We need to match their situation with the right financing option. Sometimes that means working on credit scores or saving for a down payment, but there's usually a path forward if we plan properly. Documentation is key in manufactured home financing. Think of it as telling the home story to the lender. We need to verify the HUD certification, check foundation requirements, confirm land ownership or lease status. All these pieces matter. I've developed a system to make sure we have everything ready before we even approach a lender. Sometimes we run into challenges. Maybe a client's credit isn't quite where it needs to be, or perhaps they're struggling with the down payment requirements. That's when we get creative, looking into down payment assistance programs, exploring different loan types, or sometimes just creating a plan to help them qualify in the future. Remember, understanding these financial aspects isn't just about knowing the rules, it's about helping your clients achieve their dreams of home ownership. When you can confidently explain their options and guide them through the process, you become an invaluable resource,